for decades, you've heard the same advice, right? To win at retirement, you pack up and move to Florida for that sweet 0% state income tax. But what if I told you that for most people, that advice is just mathematically wrong? Today, we're going to dive into the real numbers and pull back the curtain on an incredible wealth defense strategy that's hidden in plain sight. Non-Florida, but right next door in Georgia. Look, the Florida promise of zero income tax. It looks amazing on paper. It really does. But here's the problem. While you're not paying the state, you end up paying this massive, unavoidable, hidden tax to insurance companies. Homeowners insurance premiums are just exploding, with some retirees paying over $14,000 a year. I mean, that can just crush a fixed income. So this brings up a really interesting question. Could a state that actually has an income tax end up being the smarter, cheaper choice? It sounds totally backwards, I know. But when we look at the whole financial picture, the Georgia reality starts to build a pretty compelling case for a different way to think about a tax-free retirement. All right, so the key to this entire strategy is one specific piece of Georgia law. And this isn't some shady loophole, it's a deliberate, powerful tool that was designed to help keep senior wealth in the state. Let's break down exactly what this Georgia Shield is all about. The official name for it is the Retirement Income Exclusion. And what it does is simple, but wow, is it effective. If you're 65 or older, Georgia just lets you subtract, or shield, $65,000 of your retirement income from your state tax return. Poof! It just vanishes from the amount you can be taxed. Now listen up, because this is the single most important detail that so many people miss. This is not a one-per-household deal. This powerful $65,000 shield applies to each individual spouse. And this is where you really see the power of that rule. For a married couple where you're both over 65, you get to stack those shields. That's $130,000 of income that can be completely protected from Georgia state taxes, right off the top. But you've got to be careful. There's a catch here, and we call it the wasted shield phenomenon. It's a classic use-it-or-lose-it benefit. So if all the retirement income is in one spouse's name, you only get to use their $65,000 exclusion. The other spouse's shield, it's completely wasted. This makes balancing your income streams before you retire absolutely crucial. So you might be thinking, okay, this is great for people with big corporate pensions, but what about the rest of us? Well, this is where the strategy goes from good to absolutely incredible. The state's definition of retirement income is so ridiculously broad, it acts like a Trojan horse, basically sneaking your entire investment portfolio inside this tax-free shield. So that's the million-dollar question, isn't it? What does the law actually consider retirement income? When you hear that phrase, you're probably thinking about a 401k or some old company pension. But, the legal definition is way, way broader than that. When you actually dig into the code, you see it's not just pensions. Your interest income from bonds, the dividend income from your stock portfolio, even the net income you make from a rental property, it all qualifies. It's an unbelievably generous definition that covers most of the ways you'd get passive income. Okay, stop and think about what this really means. This rule basically transforms your normal, everyday taxable brokerage account or your real estate portfolio into a state-level tax advantage machine. For Georgia tax purposes, it starts to behave a lot like a Roth IRA, where that qualified income comes out tax-free all the way up to that massive exclusion limit. Okay, so now that we know all the pieces, let's put it all together and do the math. We're going to stack all these benefits on top of each other and see just how much income a retired couple can earn in Georgia before they have to pay a single dime in state tax. All right, here's how it all stacks up for a married couple, both over 65, in 2025. First, you start with their combined $130,000 retirement income exclusion. Then, you stack Georgia's very generous standard deduction of $24,000 on top of that. And finally, you add the senior deduction, which is another $1,300 for each of them. And here it is, the final number. A married couple can bring in over $156,000 in income before they owe any Georgia state income tax. Now, you compare that to forking over an extra $10 grand a year in insurance in Florida, and well, the math starts to look a whole lot different, doesn't it? Now, I have to give you a really critical warning here. This strategy is incredibly powerful, but it's got one major limitation that you just cannot ignore. We call it the earned income trap, and if you fall into it, you could get a very nasty surprise tax bill. So here's the deal. And it's super important. The Georgia Shield is designed to protect your passive wealth. That's money from your investments, your rentals, your pensions. It is not designed to shield active wages you get from a job you might take in retirement. The state makes a very, very clear distinction. For the 2025 tax year, the law only lets you shield $5,000 of earned income per person. That's it. It's just a tiny fraction of the $65,000 shield you get for all that passive income. And let me be perfectly clear about this. If you go out and earn, say, $30,000 from a part-time job, only that first $5,000 is shielded. The other $25,000, it's fully taxable. Do not make the mistake of thinking your big $65,000 retirement shield is going to cover your salary. It won't. Okay, let's bring it all home. We've looked at the hidden costs lurking in Florida and the incredible hidden benefits waiting in Georgia. Now it's time for a direct, head-to-head comparison to see which state really comes out on top for most retirees. You know, when you actually put the numbers right next to each other, the picture gets crystal clear. In Florida, yeah, you might have zero income tax, but you get slammed with a massive insurance bill. In Georgia, not only is that insurance cost way lower, but for a whole lot of retirees, the state income tax bill is also zero. You're just keeping more of your own money, period. So what's the bottom line here? Look, the data is pretty clear. For the vast majority of retirees, we're talking about those with household incomes under about $175,000. Georgia isn't just a good option. When you factor in all the costs, it's mathematically the superior financial choice. This is a fantastic benefit, right? But here's the thing. It's not automatic. It doesn't just happen. You have to actively raise your hand and claim it on your tax return. So let's quickly go over exactly how you do that. So when you're filing your Georgia state taxes, that's Form 500, you've got to make sure you complete and attach what's called Schedule 1. This is the spot where you'll list all those different kinds of passive income, the interest, the dividends, the rental income, to officially claim your exclusion. And remember, if you don't file the schedule, you don't get the benefit. It's as simple as that. So we started this whole thing talking about that common wisdom, that Florida is the undisputed champion of retirement. But now that you've seen the real numbers, the hidden costs, and the powerful, overlooked benefits right next door, the final question really is for you. Is it time to run your own numbers and maybe recalculate your plan?